Welcome back to another episode of the Startup Junkies Podcast. Before we begin, we would just like to say thank you for joining us wherever you are. This would not be possible without you taking the time out of your day to check out our show. My name is Matthew Ward, and I'm on the Startup Junkie team. Today, I have my co-host, Jeff Ameriine, who is the founder and managing director of Startup Junkie, and Caleb Talley, who is the director of marketing and events of Startup Junkie Foundation. How are you guys doing today?
Doing
It's
great.
Friday. It's all upside. It's all good.
I'd enjoy Friday. We got Super Bowl whenever we're recording this, so we'll see what happens. So before we meet our special guests, we want to tell you a little bit about Tiny Capital. Are you looking to sell your wonderful internet business? Tiny partners with founders to give them quick, straightforward exits that protect their team and culture. They'll make an offer within a week, close a deal within a month, and keep your business operating for the long term. Get in touch at tinycapital.com/startupjunkies, and they'll let you know within a couple of days. Now, today we have Eric Shirley, who is the Director of Acquisitions at Four Oaks Capital. Four Oaks Capital, a North Carolina-based real estate investment firm, has created a new way for cash-rich millennials and younger investors to invest in traditional real estate without being tied down. So Eric, thanks for coming on, and could you tell us more about yourself and this new opportunity that Four Oaks has created for younger investors?
Yeah, absolutely. So my name's Eric Shirley. I'm the Director of Acquisitions here at Four Oaks, and my team and I'm one of four partners, and my acquisitions team, we're responsible ultimately for sourcing real estate opportunities in the multifamily space, for vetting future markets, all the legal side, the lending side, due diligence, pretty much everything that goes from sourcing deals all the way through to closing. We came together about 18 months ago. Not to bore you with the long story, but basically all four of us were competing against one another in the same marketplaces. And after driving prices up on deal after deal, we decided that it was a ridiculous strategy to try to compete. Why not try to take down some opportunities together? So we closed on our first multifamily investment about 14 months ago. And in the past 12 months, we've closed on 8 assets, just under 500 doors, raised about $10 million in capital from private investors. And we're geared up for a strong 2021. We're excited for the future.
So talk about how you got into it. How did you, what led you to the dark side of real estate and multifamily and all that?
Sure. So I was a collegiate swimmer at the College of Charleston. I broke my ankle at the end of my sophomore year. And about that time, one of my roommates was going to go study abroad in Spain. So he subletted out his apartment to a buddy of mine. And his guy I hadn't seen in a couple of years, but was interested to be in Charleston. And I was like, come on down. Well, he was flipping houses. He was a little bit older than me, and he was flipping houses, and he taught me the ropes. And so I started flipping houses while I was still in college. We flipped about 36 houses in 2 years in Charleston, South Carolina.
Wow.
This was before the great fallout of 2008. And you could buy a house on a Friday, 2 weeks later, after putting a little work into it, you could make 40, 50 grand. And so it was my first taste of real estate. It was my first taste of kind of using private equity and private funds. I was a college kid. I didn't have any money. So did really well with that, kind of transitioned from the fix and flip into the buy and hold, and built up a residential portfolio. Realized from a scalability standpoint, it was going to be a challenge to reach, my family's financial goals based on, I remember it like it was yesterday. It was my best cash flowing property. I love this property. And then the roof needed to be replaced. And it ate up every single dollar of profit I had made from this stupid single family investment. And I was furious. And I was like, there's got to be another way. So started studying multifamily, fell in love with the concept and fell in love with the idea of forced depreciation instead of relying on market appreciation. And spent about 6 months to a year educating myself, put together, partnered with a buddy of mine. We started our first company, and kind of the rest is history from there. It was really just a product of need, knowing that what I was doing wasn't gonna fill my long-term goals, and that's not the way I wanted to do it. So just looking for kind of a smarter way, a more efficient way, I should say, not necessarily smarter.
Then you hit you alluded to the 2008. You hit that time frame, and then a decade later hit another, black swan type of event. Can you compare, what it's like having seen that and then now going through the current pandemic?
Yeah, it's funny because one of the things I learned, when you're young and younger, I just turned 40 last week. So, but when I was in my young 20s, I was hungry and I was ambitious, and I didn't fully understand the gravity of using private capital. And what I mean by that is we were in a really hot area at a hot time, right place, right time, doing all the right things. It was really hard to fail. And then when 2008 came, it put a lot of things in perspective and really showed us the importance of kind of being conservative with your approach, and the ultimate goal being to protect your investors' capital. And we were able to do that in 2008. But we really have kind of taken that to the next level with this. And it's not just the pandemic. We're at the tail end of an economic market cycle. If you study kind of the economic histories, we're in the midst of a global pandemic. We have this CDC eviction moratorium, which certainly hinders our ability to put paying tenants, get rid of non-paying tenants and put in paying tenants. And then we have this, and this certainly isn't a political comment, but we're transitioning politically from one party to another with a lot of uncertainty as to what that's going to look like and how that may affect tax structures and 1031 exchanges and all these things. So there's a lot of hesitation and trepidation in kind of the private equity scene. And so really coming in with full transparency, over communication, hyper conservative underwriting. And, at this point, we look at 100 to 120 deals a month. We're submitting maybe two offers a month based on that deal flow. So we sift through a lot of less than ideal opportunities to find the diamond in the rough. But that's our commitment to our investors to find those unicorns that still exist.
Eric, how was the process of raising funds? I saw that you actually had a extensive background in sales, so be curious how that helped you out.
Yeah, I mean, that's been critical, I think, with not only myself but my partners. When we were kind of learning the ropes, one of the things we did was we invested passively in a bunch of opportunities with other syndicators and other folks that were doing this. And it was done for two reasons. One, to really kind of learn how it all worked and really get a good, firm understanding. What better way to do that than to be involved with your own capital? And then the second way was to learn what we liked and what we didn't like. And there were kind of three things that were lacking consistently. And it was transparency, lack of communication, and a lack of education. Everyone wanted to be your best friend when they were recruiting your capital, but the moment they got your check, it was funny how the phone call stopped and it was, who are you again? And so that was something that rubbed us the wrong way. And we were committed when we built Four Oaks. Those are kind of our three foundational pillars. And so when we talk to potential investors, it's genuinely a relationship building process. It's tell me about your goals. What are you trying to do? What's led you to this journey? And it's one of my sales mentors early on when I was in medical device sales. I remember he used to say, you have two ears and one mouth for a reason. Use your mouth to ask questions and use your ears to listen. And so that's really what we try to do, is build a customized strategy for our investor base. And when I say customized, we've turned folks away that had a tremendous amount of capital to play with that just weren't the right fit for our brand and our culture. And at the end of the day, we call it our Four Oaks family, but we don't have investors. We have, partners in all these deals, and we're really looking to build something for the long term. It's not lost on me specifically what goes into having $50,000 or $100,000 of liquidity to invest. It's a tremendous amount of responsibility that people bestow on you. And so really understanding what their goals are, making sure you find the right opportunity for their goals, and then placing them into the right product. I think that's really helped us with the money raising side.
And on the ROI as part of it, there's both a capital appreciation play on the property, and also there's an income stream. Or talk about how it might work for an investor.
Yeah, absolutely. So there's really three ways to make money, and two being the primary. The first is through what we call forced depreciation. And in commercial real estate, unlike residential real estate, with residential real estate, your property's worth what your neighbor sold his property for. You have very little control of what the market is and how that market's going to fluctuate up or down based on the economy. With commercial real estate, it's a little bit different. You use a number called NOI, and your net operating income is your revenue minus your expenses. And then you use this kind of multiplier, for lack of a better term, called a cap rate. And so you can have two identical properties side by side with drastically different valuations based on their performance. So if we buy a product, while it's going to generate revenue and cash flow through the holding cycle, on the back end, we're increasing the value by increasing the NOI. And so the way we look at it, like a cap rate is a ratio, like a 7 cap would mean how many times can 7 go into 100, roughly 14. So every dollar of NOI generates $14 of value. So if I raise rents in a 100-unit apartment complex by $100 a piece, that's $10,000 at a 7 cap. That's a $1.4 million increase in value that we created just by raising rents $100 a month. Yeah, that's a bad example, but like just, it's amazing how it's the little things, billing back for utilities, offering services like reserved parking, pet deposits, and pet rent. There's a number of properties that we have that have a tremendous amount of animals, resident pets.
Sure.
Not like horses running amok, but like, you know, cats and dogs, and $25 a month per pet. It's not an unrealistic fee. And there's additionally, obviously on the back end, when the tenant moves out, there's things that come with having a pet in the unit that we have to take care of. So there's an incurred cost there for us. So it's these little NOI boosters, we call them, that really help drive the value on the back end. So most investors are looking at about an 8% cash on cash return on their money during the hold time. And then they get a nice large chunk from the sale proceeds, all with the tremendous tax benefits that commercial real estate has to offer now with pass through depreciation.
It's really interesting. Do you do anything special from a system standpoint with your property management, maintenance? I know there's been some pretty cool SaaS platforms that have come out that do some of that. Or what are you guys doing in that regard?
You know, there's so many things to learn on the acquisition side, and there's so much material, books and podcasts and coaching programs and all these things dedicated to how to buy these things. There's nothing out there that tells you how to run them once you take them over. So that was probably our biggest learning curve, was kind of the systemization and the process implementation and creating those from scratch. You know, at the end of the day, I don't want a business that I am the business. I want a business that when I stop being the business, it continues to run like a well-oiled machine. And those things don't come without processes and procedures. So, you know, with the property management company, we've been very fortunate that the property management company that we use has some phenomenal systems in place for the actual kind of operational side, getting the right tenants in and screening tenants and all those things. Where we've noticed the biggest disconnect comes on the project management side and the lack of construction background and the things that go into that. And there can be a drastic kind of gap between a well-oiled property management company that has that really understands the construction management and the project management side, and one that doesn't. And so I'd say that's where we've focused a lot of our efforts, is really utilizing systems and processes on a kind of a large scale. You know, if we have 4 projects going simultaneously in multiple markets, how can we take advantage of kind of the operational efficiencies and the economies of scale to bring our costs down, not only in a specific product category like flooring or sinks and countertops, but even on a labor side of, you know, if we can leverage labor partners and say, hey, we've got 400 units in the next 2 years that we need flooring in, we're able to really negotiate down pricing. And that's something we're spending a lot of time. We actually brought on a data analyst that works for us now, and that's what she does. She not only runs analytics on the project management side, but also with things like emerging markets and trying to find the next, you know, hot market before it gets hot.
Oh, good stuff.
What's that next market?
Yeah, well, I'd love to tell you, but I'd have to kill you. Okay. But we're super bullish on the Southeast. You know, the Southeast has so many driving metrics that continue to make it flourish even in this pandemic. I don't know if you guys have seen this or not, but the IRS actually tracks the migration of income. And if you look at the East Coast and the West Coast has a ton of folks migrating down to up, in this case, to Boise, like in Idaho, Utah, Phoenix, Scottsdale, that area. On the flip side, if you look at the East Coast markets, New York, New Jersey, Pennsylvania, Connecticut, all of those markets, there's a tremendous amount of money coming down to the Carolinas and Georgia, Florida. North Carolina, for example, saw an 18 billion with a B migration of revenues from those 4 states, those northeastern states, into North Carolina in 1 year. I mean, think about that. That's so much money. And then you've got the manufacturing and the warehousing and all these things that are building off of that. There's just a ton of metrics. I could talk all day about the different metrics that we look at, but we're super bullish on kind of these inland markets that are creating what are called inland ports. And you see these companies like BMW, Michelin, that are importing goods from China, bringing them into the East Coast ports, then bringing them in by rail or 18-wheeler about 2 hours inland. And now they have their manufacturing facilities and their warehousing facilities set up around the interstate infrastructure, so they can easily ship them out to the Atlantas and the Raleighs and the Nashvilles. And so we track a lot of that.
I mean, it seems like there's a couple things. With the pandemic, people have proved they can work from anywhere, and business travel is closing down. So this idea, it's no longer kind of a negative connotation to be a bedroom community. Bedroom communities are now working communities, and the office is in someone's home. I think that the net positive for lower cost areas is you're going to continue to see the migration from the Northeast, the high tax areas, the high cost areas. And it's real interesting. I mean, it's maybe a once in a lifetime change what's happening. And it sounds like y'all are well positioned to accommodate some of that.
We've certainly, and I would be lying if I told you we saw a global pandemic coming, but we certainly try to focus on what we call our tier 1 markets, like your primary markets and even some of the secondary markets. I'm looking in some of the sub markets 15 to 20 miles outside, where as they continue to expand out and the cost of living's lower, the demand for product is there at a price point that is still affordable. And even looking at little things, honestly, like the difference between the price of home ownership on a monthly basis and the cost of renting. A lot of our tenants are divorcees. And if you're now a single father with, kids that you get every other weekend and maybe every Tuesday, you don't necessarily want the yard with the white picket fence and all that, because that's upkeep that you don't want to have to take care of. But you still want the amenities like a pool and a playground and a great space for your kids. And so we're seeing a lot more of that kind of migrating out to the tertiary markets. Has really helped us come in and deliver high quality product in an area that was lacking that.
Eric, does Four Oaks have a formal process of balancing between keeping the doors full while optimizing NOI, cap rate, et cetera? Or is that more of a gut case by case sort of analysis?
Yeah, it's more property specific and business plan specific to that, to that property. Certain properties are heavier lifts. And I'll give you a great example. We closed on a property in December, 167 units in Augusta, that has about 12% physical vacancy, but it also has about 12% economic vacancy. So we have a large chunk of the tenant base that is not paying. And at the end of the day, economic vacancy is way worse than physical vacancy. Physical vacancy is opportunity. Economic vacancy, someone's taken up your rental and you can't do anything about it. Not only are you not collecting money, but there's no opportunity there as well. We do have some formulas that we've put together that help us kind of mitigate some of those factors. I think it's really important when you're looking at this to recognize kind of your hold period and what your strategy is. So with a lot of our product that we buy, it's flawed. It has deferred maintenance. It has mismanagement. And so we recognize that coming in. And instead of saying, all right, we're going to do all this in the first 12 months, we're going to be at 95% occupancy with all the units renovated, we really split it up gradually over kind of a 3-year period to be able to create realistic projections without affecting the good tenants that are on site. And, we always offer our renovated product to current tenants first to give them the opportunity, to have the first shot at that kind of renovated thing. We certainly don't want to penalize good tenants for being good tenants. Does that answer that question? I think I took a little roundabout, but I hope I answered it.
No, definitely. That makes a lot of sense. It's not as straight and as narrow as you think it would be, especially with what's going on right now and what's coming about. What does success look like for Four Oaks in 3 to 5 years, or is that too broad of a question right now?
No, I think it's a great question. I think right now, as we continue to scale, it's increasing unit count, but the number of units is like, I get asked the question all the time, how many units are you looking to take down in 2021? It's not about the number of units, it's about the quality of the units. So if we're only able to find enough product to generate 250 new units into our portfolio, but they're the right units, that's a win. Obviously, we'd love to get 1,500 quality units if we could, but sourcing these deals is becoming more and more challenging. So I think what success looks like is continuing to optimize the properties we have. Every property that we have right now is exceeding projections right now in the midst of a pandemic. So we're very fortunate in that regard. Our underwriting has been very conservative and we're outperforming on every level. So that's certainly a win. And I think also from a scalability standpoint, continuing to implement those processes and procedures so that, we're bringing on employees now. We're no longer a four-man show. We've hired a data analyst. We've hired a CFO who's worth her weight in gold. I mean, that was another thing, just on a quick digression. If you don't have an accounting background, you need to have a good accountant, because reading all these reports are great, but if you don't know how to interpret the numbers and what they really mean, it's all irrelevant. So having that good CFO in place has been critical for us. We have two more employees we're looking to bring on the next 3 months. We're expanding into the educational scene. We're expanding into, we just launched a brand called Cash Flow Concierge, which is basically for high net worth individuals that want to get involved in real estate, but don't want to be part of kind of the crowdfunding mentality. They want to come in and own their own product. It's kind of a multifamily consulting service where we do everything and hand them the keys at closing, kind of for a finder's fee. We've done really well with that in the last I guess it's been about 4 months now that we've launched that. We've closed on one deal for one of our investors and we have 2 more under contract. So that's proved to be fruitful. So it's really we're trying to take the opportunities that we're finding in the marketplace, whether it's on the construction side or the PM side and the management side, and figuring out how to bring those in-house to kind of build a better mousetrap. Anything we're paying someone else to do, how can we bring that in and figure out a way to make it profitable in-house?
It's really
you
cool.
alluded to it earlier, just like the formation of the organization, you and competitors coming together. How does that even happen? I mean, what's the first step in that parlay?
Was there bourbon involved?
Yeah, bourbon and humility. I think that was one of the biggest things that was a challenge for all of us, because we had all been very, very successful in our previous endeavors before coming into this realm. And then on top of that, you're taking these super hyper aggressive type A personalities and trying to say, hey, now we're going to work together. And what does that look like? And who's going to do what? And so really having the humility to step back and say, okay, here's my strengths and here's my weaknesses. And I think for a lot of us that have had success in whatever facet of life, being self-aware enough to recognize where you're weak is hard. And being able to not only recognize it, but then pass it off to someone else who it's a strength, and having that trust and accountability, that took some learning. And we had to make some pivots internally of certain folks that we thought were going to be a better fit here. As we got into the meat and potatoes of things, turned out to be a better fit here. And being able to talk as brothers instead of talking as coworkers, and having those tough conversations and be candid. It's not always easy, but I think that's what's kind of allowed us to elevate to the level that we're at now.
I mean, has that helped you form the sort of cohesive culture that you can feel like will allow you to scale? For sure. And not even within the culture itself. I mean, that's certainly been a hugely instrumental part, but even when speaking with investors, you had asked earlier about the sales side. My sales background certainly allows me to speak comfortably about things and ask for money. And that's the hardest part, is being able to ask someone to give you their money, if we're being honest. Right. But having those different personality types, and everyone brings something different, right? And so when you have an investor that you're talking to, we think it's really important that they talk to the team individually and get to know each individual kind of working counterpart. And
not everyone is, this is a hard thing for me to admit, but I'm not the best fit to talk to everyone. You know, I like to think I'm likable. I like to think I'm approachable and I'm a wealth of knowledge, but if we're not vibing or we're not clicking, that's the time for one of my other partners to step up and build that relationship and find that those relatable, you know, things to build that confidence. And that's where I think we really kind of separate ourselves from the pack. Is it's never about us. It's always about our investors. Everything we do is in the best interest of our investors. And I think that shines through our dialogue.
What are some of the challenges you anticipate?
We look at everything as kind of a short, medium, and long, right? We have the immediate challenges, then we kind of have the mid-range challenges, and then we have throwing darts at a board of, if this happens, how are we going to pivot? I think in the immediate future, it's collections. You know, collections have really been strong for everyone in the multifamily space, really, who bought the right way. Collections have been strong, and because of that, multifamily is becoming more popular than ever. Continuing deal flow, you know, we get a tremendous amount of deal flow, but finding those really good opportunities has become more and more challenging, especially with cap rate compression. You know, I couldn't tell you the last deal I looked at that hasn't been flipped 3 times, at a minimum 3 times in the last decade. And then there's a lot of things going on in the marketplace right now that I think are going to end up putting a bad name on this industry. I think there's some folks out there that got into this kind of like I got into single family, just right place, right time. And they were sitting on top of a rocket ship about to take off. And their success and their portfolio is not necessarily indicative of their skill sets per se. And because they've had a certain amount of deal flow and a certain amount of success, they built this brand awareness. And so they have folks continuing to come back to the well, but they've really never been tested. And now more than ever, the ability to think outside the box and pivot and think creatively is more important than ever. And so I see a lot of opportunities that people reach out to us to partner with on, or people ask us to invest in, that I look at the underwriting and it's frankly aggressive and slightly terrifying because there's no margin for error. And I think we can all agree that the performance of the marketplace in the last 5 years is not indicative of what the next 5 years is going to look like. And so my fear is that there's going to be a lot of folks that are going to be failing, and not necessarily like lose your money failing, but not coming anywhere close to the projections and creating a lot of doubt and casting a lot of shade on this industry. And so I think it's really imperative for folks like us to educate, to instill trust, and to deliver so that when people see the benefits that real estate investing on a passive level can have, they have a trusted source to turn to that's going to deliver it might not be the sexiest product, but it's going to be a good, sound, cash flowing product.
How do you manage we do a lot of early stage angel investing and have run several funds, and it's always a trick to target accredited investors. You know, the SEC accreditation rules there's so much intellectual dishonesty associated with that. There's nobody standing at your local casino stopping someone at the door from blowing their life savings,
right? But
there's restrictions on how you can invest your own private money. How do you guys manage to find the accredited investors and qualify them? And what does that process look like?
Yeah. So, early on it was friends and family, like most folks start. And then as we built a track record and really started delivering and exceeding expectations, we got a lot of referral business, and the bulk of our business does come from the referral sector. We've brought in a marketing firm that we're working with, and we're starting kind of a direct to consumer approach that we're really, really excited about. There's a great book, a marketing book. I call it the yellow book because it's yellow and I'm terrible at remembering titles, but it's by a gentleman named Alan Dibb. And it's a phenomenal book about marketing. And I think the next step for us is really going direct to the consumer. And instead of buying these accreditation lists, targeting folks in LinkedIn has been a huge tool for us to kind of target. We have a podcast, and we launched our podcast about 6 months ago, and you guys certainly know more about podcasting than I. One of my partners heads up that side of things, but we had 20,000 downloads of our podcast in the first 5 months. And wow, that was a big win for us.
That's strong.
And so thank you. And so really trying, like, I don't know if people can see the video or just the audio, but like, I am not your proverbial corporate America look, right? And I'm an avid surfer, and like a lot of our culture here is being outdoors and hiking, and it's wellness, both financial and physical wellness. And we're big into yoga and meditation. And we just believe that, life is short, and you have to take advantage of every aspect of it to live your best life. And so I think these little differentiators, we're not engineers, and we're not like, we're guys, and we're just four dudes that love what we do, and we've been really successful. And, we're not here throwing out fancy words. Like, we just talk, like we have conversations, and it's relatable. So I think that's been a big differentiator for us in the marketplace. And, but as far as, the accreditation rules, there's a lot of gray there, and it's been a challenge. Certainly having someone that's in the military at a high level that works at the Pentagon adds, weirdly enough, it's built in a ton of instant credibility. That comes with some certain assumptions that really we've been able to build off of. And we do have a large military presence that invests with us.
Plus, it probably keeps the jerks away if they see Marine Lieutenant Colonel as one of the investors.
It does. And it's funny. Like I said before, we've turned people away that had tons of money that they wanted to place with us because they weren't the right fit. And at the end of the day, when we talk to investors, it's much of them interviewing us to make sure we're the right fit for them. It's the same for us. I don't need someone that I'm ultimately responsible for their investment if we're not aligned kind of with the strategy. It doesn't make sense. It's not a win-win, and there's no point in pursuing something that's not a win on all fronts.
So we there's typically one question we ask, and we're kind of at a point where we normally begin to land the plane, but you've had a ton of experience. You started on this kind of stuff when you were in college. If you could go back to that time with the knowledge you have now and give your younger self some advice, what would that be?
Yeah, so it would be to get into multifamily instead of single family. But I think as much, I made a lot of mistakes along the way, and I learned from all of them. And I was very fortunate that none of them were catastrophic. And I like to think I'm self-aware enough that when I make a mistake, to stop and say, okay, what went wrong? Why did it go wrong? And how can I avoid doing this again? When I was young, I was pompous and I was cocky, like most young guys probably are. And so, I didn't have the self-awareness and humility that I have now. And I wish I could have changed some of that. But it's neat. I have two little girls, 6 and 8, and we play a ton of games like Life and Monopoly, and Robert Kiyosaki, who's kind of one of my financial icons. He has a Rich Dad Poor Kid. And so, my daughter, my 8-year-old, got the graphic novel of his that she read about the difference between assets and liabilities. And, we teach our kids, like, don't go blow your money at the toy store. They actually invest in daddy's syndications. And, so I have a couple $100 of birthday money and allowances from the last few years that we have tied up, and they're starting to see the value of how to make, instead of working for money, how do you make money work for you? And I wish that my parents had the foresight to instill some of those things. I went to college. I didn't know what credit was. I didn't know how to balance a checkbook. Still don't. But thank goodness for online banking. But it's those little things that, ultimately I'd like to get into the teaching arena. I'd like to be a college professor and offer a class in entrepreneurship to basically, teach young people that you don't have to go into the rat race and you don't have to go get a 9-to-5. Find your passion and figure out a way to monetize it. And there's a ton of ways to do that.
No, that's great. Where can folks find out more about what you're doing? I mean, we do have downloads from 100 countries, pretty good followership. Where can they find out more about what you're doing at Four Oaks?
Absolutely. Our website is www.fouroakscapital.com. You can check me out on LinkedIn. I'm not sure what that link is, but Eric Shirley on LinkedIn. Look for the beard and the crazy hair and you'll find me. And then we have a really cool podcast that it's called The Diary of an Apartment Investor. And it's basically taking an aspiring syndicator, someone that wants to break into what we're doing, and an experienced syndicator, and really kind of passing we spend about 10 minutes with the experienced person, giving their background, letting them kind of talk about what they do. Then we pass the reins over to the new investor or to the aspiring investor and say, what do you want to ask to get yourself started? And it's really been, there's so much generosity of time and knowledge in this space. And we really want to pay it forward. So, email me, Eric Shirley at fouroakscapital.com. Find me on LinkedIn. I'd love to hop on a phone call and just share information. And if anybody's interested in getting into this arena, my goal is to help anyone I can do that, because we had a ton of folks that helped us.
Eric, that's great. I mean, that's a good place to finish. Thanks so much for coming on today. It was really a great conversation.
Well, thank you guys so much for having me. I appreciate the opportunity, and it's a great platform you guys have here.
Well, best of luck. Hope to talk to you soon.
Thanks so much.
Great weekend, Eric. See you.